Before we get started today, I'd like to personally thank all of the healthcare workers for their efforts in fighting the virus. We work with a lot of healthcare organizations and individuals who are, deep in the fight here, and we really appreciate and value all the efforts that they're making in trying to fight this virus and help not only everyone get healthy, but the economy get back on track. So, from all of us at CapStrat to you, thank you. So I'm joined today with Mike Rarey to discuss the March review and market outlook. And Mike, it was quite a record-setting month. Not the kind of record-setting you want to be known for, given the fact that most of those records were in the wrong direction. And it seems like in the last month, we've lived a decade in market terms. Yeah, it's almost hard to keep track of everything that's happened because it's happened so fast and it's been so enormous in terms of the point gains and point losses.
Exactly.
Let's talk about the economic records. There's been quite a few of those as well. Probably too many to talk about here today, but let's highlight some of the economic records that we're setting right now.
So the biggest one and sort of the highest frequency data point is weekly jobless claims, and those coming in at a new all-time high of 3.3 million. So we've talked in prior videos how this is a health crisis and this is an employment crisis, and plenty of signs of both of those. So unfortunately, a lot of folks being laid off at a record clip.
In terms of economic stimulus records, we've set quite a few of those as well.
Yeah, the total stimulus, if you combine the fiscal stimulus package that was recently passed, so this is the phase 3 fiscal stimulus package, which is worth roughly $2 trillion. You compare that to our prior largest fiscal stimulus package in 2008, which was only $800 billion. You can see, unprecedented fiscal stimulus. And then you combine the monetary side. So the Fed increasing the size of its balance sheet at a record pace. And if you combine the total fiscal monetary stimulus, you're potentially looking at $9 trillion of stimulus. And you compare that to 2008, the total stimulus was somewhere around 20% of GDP, and it was too little too late.
Take us through the markets, and starting with fixed income and what records we set in the fixed income market this month.
Somewhat early in the month, Treasury yields hit all-time lows. The 10-year Treasury fell to as low as 0.54%. And then a little later in the month, the 3-month Treasury bill fell to negative 0.14%. So negative interest rates are certainly here. In the high-yield bond market, high-yield bond spreads widened out to their highest levels since 2008 due to fears of default, and especially within the energy sector due to the oil price war. And a big reason why interest rates were hitting all-time lows was because the Fed's balance sheet has swelled to a new all-time high. It's growing at a vertical pace, and it's now well over $5 trillion.
All right. Quite a few records were set in the equity markets. Take us through some of those this month.
The first thing that happened was the longest bull market in history finally ended. And the volatility during the month was record setting. So many days where futures would be limit down and then follow with a circuit breaker. So then the cash open being down 7% in a matter of minutes. So hitting circuit breakers day to day. Plenty of days where we went limit down on the futures and the next day limit up. So all that means the VIX, the fear gauge, a measure of volatility in the U.S. equity market, hit a new all-time high, eclipsed the prior all-time high from 2008. Some of the largest daily percentage gains and losses on the Dow in history. So the second largest percentage loss happened on March 16th, down 12.9%. And then just a week later, the fourth largest percentage gain, up over 10%. So just a tremendous amount of volatility. And ultimately, Equities from their high on February 19th to their low on March 23rd were down 34% in roughly a month. So that's the steepest, sharpest, most rapid decline since Black Monday, 1987. And then they followed that up with a 3-day rally of over 20%, which is the strongest 3-day rally since 1933.
Given what's happened in March and our previous discussions regarding a V-shaped recovery, a U-shaped recovery, or an L-shaped recovery, has anything changed as we sit here today, Mike, with respect to any of those outcomes and the probabilities associated with them?
We still believe that a V-shaped or a U-shaped recovery are the highest probability outcomes, primarily because of the size and speed of the fiscal and monetary response. We think that basically takes an L-shaped type of an outcome or a Great Depression type of an outcome off the table. And so if you're faced with a V or a U-shaped recovery and you think the stock market was down 34%, that means from the bottom, it would have to be up 50% to recover all the losses. And it's really just a matter of timing. If this is a V-shaped, then that recovery could happen in 3 to 12 months. So you're talking about returns of potentially 50% in a year in equities. If you want to think about more of a U-shaped recovery and you say, well, what if this recovery takes 5 years, similar to the tech bubble burst and 9/11, then you're still looking at almost 10% annualized returns for equities from the bottom. So it's really just a matter of time at this point, because the Fed and the bond market have done a very efficient job of making sure there is no alternative to owning equities at this point in the cycle.
So some other things that we want to make you aware of. We've just finished going through the entire fiscal stimulus documentation, and we're in the process of putting together a slide deck to bring our thoughts to you on that package later this week. So stay tuned for that. In addition, you can check our YouTube channel for updates on other legislative items such as the CARES Act, which was recently passed. For those of you who have investments in 401k plans and are interested in understanding how the CARES Act could impact you and your plan, look on our YouTube channel for information there, or contact us for more information and we can send that information out to you.